Hello and welcome to this special report here at XM.com. We'll be discussing the upcoming U.S. midterm elections and the potential reaction in the markets. I'm Maria Pachurdis, and joining me is senior investment analyst Marios Hadjikyriacos. So Marios, on November 8th, Americans will head to the polls to elect their new Congress. What issues are at the heart of this election, and what are opinion polls suggesting?
Hello, Maria. So I think we all know the issues. One of the most contentious issues lately is the whole fight around abortion rights after the recent Supreme Court decision. We've got climate policy and a lot of other stuff. But if you look at opinion polls, poll after poll suggests that the main issue for voters is either the economy or inflation. If you put those together, they are overwhelmingly the most important issue. So it's about economics, most probably. That's how people usually vote. Now, what do we expect this time around? So the Democrats currently have control of Congress. They've got a slim majority in the House of Representatives, and even though the Senate is split 50-50, they've got the tiebreaker vote since the president is from their party. Now, opinion polls and betting markets suggest that they won't keep both chambers. So opinion polls clearly favor the Republicans to win back the House of Representatives. If you look at betting markets, most betting websites have the probability of the Republicans taking back the House at around 80 to 85%. So that looks like a very strong likelihood for that to happen. The Senate, though, that's a much closer call. Both opinion polls and the bookmakers view it almost as a coin toss, right? So there's a lot of uncertainty around that. The short version is we're probably going to get a split Congress.
Okay, now, how do stock markets tend to perform both leading up to midterm elections and after the results are announced? And what do you think will happen this time?
Yeah, so there's a strong pattern of stock markets underperforming heading into the midterms. There's a lot of possible explanations why. Maybe investors are hedging because of the political uncertainty. Maybe they cut their market exposure. But then, even though we see a lot of underperformance for stocks heading into the midterms, after the election has passed, we usually see a very strong performance from stocks. In fact, over the last 7 decades, stock markets have always been higher 6 months after a midterm election year. That is a strong sort of seasonal signal. Of course, it doesn't mean a lot in a year as volatile as this one, but it's always useful to look at the historical precedent. Now, how might the stock market react to this election? Well, let's assume we get the divided Congress that opinion polls suggest. Well, that will make it harder for President Biden and the Democrats to enact any anti-business legislation. They won't be able to raise corporate taxes. They probably won't be able to tighten any regulations, because if the Republicans have control of even one chamber of Congress, they'll probably block, veto any such law. So if we do get that, that's why investors like a divided Congress, because it eliminates the risk of higher corporate taxes. And if we get that this time, that argues for a relief rally, perhaps, in stock markets.
Turning to the dollar now, what reaction are we likely to get? And is there anything else we should be looking out for leading up to the election?
So the dollar, there's no clear pattern around the dollar for the midterm election. So the market reaction will most probably boil down to the following question: how do the midterms affect Fed policy? Do they argue for a lower or a higher peak in the federal funds rate? Now, if we do get the split Congress, that probably argues for a lower peak in the Fed funds rate. So think of it this way: the Republicans get control of half or all of Congress. They'll block both raising taxes on corporations, but they will also try to block any big spending initiatives. Now, if you have less spending by the government, other things equal, that probably means slower growth in the economy, slower inflation as well. So that means the Fed doesn't need to raise interest rates quite as much. So that probably argues for a pullback, some profit taking perhaps in the dollar. Now, I want to stress though, Maria, that yeah, we might see stocks rise a little bit and we might see the dollar take a step back, but those are likely to be counter trend moves, not trend reversals. And the reason behind that is quite simple. Stock markets are still too expensive. Valuations in the stock market haven't adjusted to how much interest rates have risen yet. And we've got the risk of an earnings recession, right? That's becoming very realistic, especially with the economic data we're seeing out of Europe and China. Now, as for the dollar, everything that the dynamics that fuel this powerful rally, they are still very much in play. Inflation is still hot, the US labor market is still in good shape. That gives the Fed cover to keep raising interest rates. And of course, we've got every other major currency in the world being very weak. So there's not a lot of competition for the dollar. Now, finally, of course, we have a Fed meeting just 1 week ahead of the midterm elections. That will also be extremely important for the dollar stock markets.
Marios, thanks so much. And thanks for joining us at XM.com.